taught by each trainer is also covered with what has been explored and elaborated during the session, but also to give you an opportunity to explore and understand how the tools or ITC, how you can make use of ITC tool. So it's not that we are kind of grading you for each question or exercise, but the whole idea is for you really to learn and and understand the module, understand how you can be using ITC tools in general for your work and in your future. So we are, as I said, please, all of you know that we are not looking for the right answer. It's an opportunity for you to elaborate and use tool. And after each session, we will send to you a correct answer as well. Also, may I also request everyone to mute themselves, because there are some interesting conversation which I'm not able also to understand coming through. We can certainly engage in the discussion after, but for the purpose of all participants, please mute yourself. So yeah, Mr. Tarak, please don't, take this as a learning exercise, more, as submitting, a right and wrong question. If you have any difficulties, please feel free to reach us. We have also our colleagues with us, not only today, but always, that we can go back and forth. Sam, would you like to maybe share your observation in this question?
Yes, hi, good morning, everyone. Good afternoon. For those of you who are located in India, just from my side, the purpose of this exercise is really to allow you to yourself independently start using the tools, because according to the exercise, there's always a hint where you can find the right information, etc. And at the same time, we'll complement this with answer key that will be sent to you by Lillian, so you will also have the right answer. And if you still don't understand how we managed to arrive at the right answer, please feel free to submit your queries to Lillian, and she will gather everything and send it to us. We'll reply to you via Lillian. So in the meantime, I really encourage you to use the exercise, because it's an opportunity for you to try to put what you learn via the webinar into practice, because during 90 minutes of the presentation, you are not using the tools. You're really paying attention to the trainers, what they're speaking about, how they explain different indicators, what are the analysis that can be derived. Then when you go home, this is where it really kicks in, that you have to perform the analysis yourself, and you have to use those features and functionality yourself. So really allow yourself, give yourself an opportunity to use the tools. Okay, so that's it from me. Thank you very much.
Lillian, could you please mute the participants who are not muted? Thank you. Yeah, I hope, Mr. Tarak, you understand also now, the purpose of the questions, of the exercises that we do give in the end of each. And please free, as Sam mentioned, do reach us with any clarification you might need. And yes, as a response to the question, if we are going to receive video recording along with exercise, yes, you will all receive a video recording for each and every exercise. You will receive them, as Lillian has shared to you the recording for the first session so far. Today she will share also the recording for the second session. The recording are uploaded in the YouTube, so it's very easy accessible, and you can go back and listen to as many times as you might need. As well as Sam mentioned, we will share with you the answer keys after we have received completed homework. And so you will be able then to go back and listen, and in the end, we really hope that by the end of this training program, you will be able to master the ITC tools in general and benefit from them as well. Good afternoon, everyone. Again, good morning. Allow me now to start. This is our third week of our training program for East African and India Business Support Organization. Today with us, we have our colleague, Christophe Durand, who will also be your trainer today and will take you through our third module on supply diversification. As you are aware, we'll have a 90-minute presentation followed by question and answer, but please feel free to also post your question as Christophe will start his presentation, and then we will make sure to answer all your questions. Christophe will also briefly explain what is this today's module about, and also explain a bit how the agenda will look like today. Thank you very much. Christophe, over to you.
Thank you very much, Anda. Good morning and good afternoon, wherever you are, ladies and gentlemen. I am Christophe Durand, and I'll be your trainer today. Before we jump into the tool and the statistics and the market analysis, let me introduce myself first for those who don't know me. I'm Christophe Durand. I'm statistician at the International Trade Center, and I joined the organization 16 years ago. I'm involved in the trade map project, among other things. And for what matters today, I can tell you that I've been working on the data, on the trade flows in goods in particular, for the data processing and in the past, and now I'm more involved in the data quality checks and the relation with customs. So that's just to give you a bit of background about where I'm coming from. So the topic today is supply diversification. I've seen that you are pretty into the import side. Basically, from an importing country point of view, the idea would be to see how to diversify the different supplies. So that's one thing, but I've also been told that some of you are also keen to dig into the export side, which I'm happy to show you today. So that's basically how I'm going to structure the presentation. I'm going to first talk about the supplies diversification, that is to say, from the import side, and we'll go together into the export side for you to understand how to conduct the analysis also on the export side. And we will see together that there are some subtleties, and what you think can apply to both imports and exports is actually a bit more complicated than this, right? So that's the idea. The topic today is quite technical, so I'll try to go slowly and to explain what I'm talking about and how the tool is functioning. But once again, if you have questions, please do not hesitate to post your question inside the chat. And all throughout the presentation, I'll have some breaks so that I can address your questions. so that you don't basically listen to me for 90 minutes and then suddenly we have 30 minutes for 60 minutes, and then suddenly we have 30 minutes or so to answer questions. So we'll try to make it a little bit more interactive than just a big block of me talking and then a big block of you asking questions, right? We'll try to have something a bit nicer than this. All right. So let's get started. So what I understand that most of you have followed already the presentation of TradeMap in a previous session. So I'm not going to go back through the basics, and I'm going to basically show you, take you directly to the tool, and we're going to see together how concretely how to run the analysis that we want to run. So you may be surprised that I have no PowerPoint presentation, but actually that's I think that would get the things more confused for you to have complicated slides and me talking about it. So I'll be as practical as possible and as simple as possible, taking into account the complexity of the topic. So we'll go immediately to TradeMap and I'll start showing to you how the tool is functioning. So I'm going to share my screen. Right, here we go. And now you should be able to see the TradeMap homepage. Anda, can you confirm you can see this? Anda? Are you with me? Can you confirm you can see the shared screen? Okay.
We can see it.
You can or you can't?
We can see.
Okay, great. Thank you very much. Okay, so that's the tool. That's the homepage, how it looks when you go to trademap.org. So that's something I understand you've seen. So I'm not going to go through the menu on the top where you can get the data availability and reference materials and so on and so forth. And you have all understood that from there you can start already selecting a particular product and or a particular country and start your analysis. But as you probably know already, when you go into the product combo box, you see that some products are actually marked as red because they are restricted because we haven't logged in yet. So if we want, so very firstly, if you want to run an analysis on product diversification, for instance, or supplies diversification, at a detail level, to a detail that has some concrete meaning at the company level, then you do need to log in. So that's what I'm going to do immediately. I click on login, enter my email and my unbreakable password, and I log in. All right. Now, because as my name indicates, I'm French, my preferred language is French, but I'm going to switch back immediately to English. And for the reference, for the record, it's also, the tool is also translated into Spanish and Arabic. And we are also working on the Russian translation, which should come out shortly. So let's switch back to English. And here we go. Right. So first thing first, we are here on the homepage. What do we look at? Imports or exports? Well, if we want to have an understanding of supply diversification, well, of course, that's going to be on the import side that we are going to start, right? So let's take a particular example and let's be concrete. So I'm going to choose the problematic of supply diversification of Kenya for its supplies of rice. All right. So and I'll change also to another example on the Indian side later on in the presentation, so that I'm sure I'm covering both regions. So don't worry about that. So first thing, I need to say, okay, I'm going for Kenya, right? So I'm selecting Kenya in my country combo box, right? And I want to focus on the rice, so I need to select rice in the product combo box. Two options for this. Either I click on the combo box and I type rice, right? And then the system quickly gives me a match of the products that have rice inside the product description. If by any chance I'm not sure what kind of rice is here, or I cannot see the product that I would like to get precisely, then I can just click on the outside and go to the advanced search. And over there, another two options. Either I go for some keywords, or I go to I can search by hierarchy, where here I have all the products as classified in the harmonized system, which is the product nomenclature for international trade flows in goods, right? And of course, rice is a kind of cereal, so that's going to be under chapter 10. I can break down this, right? And then 1006, that's the rice, okay? And then I have plenty of different kinds of rice. So I said, let's go for rice. So I'm just clicking on this one. So here I have a product which code is composed of 4 digits. And I know that if I go at the 6-digit level, I will have more details. So let's start with a broad overview of the Kenya's imports of rice and how and where Kenya gets its supplies from. So before I click on any button, I have already an overview of the Kenya's rice in the previews over here as a bubble graph, as a map, or as a market analysis graph, like a fancy enhanced bubble graph. So if you know already TradeMap quite well, you can directly jump to the inside the preview to see immediately the graph of the map you want. But if you're not completely familiar with this, then I would strongly advise you to go for the trade indicators and see what are the trade statistics about this. So let's go there. I click on trade indicators. And here we go. We're entering one of the typical tables of TradeMap. And with plenty of different indicators and a lot of figures everywhere. So don't be overwhelmed, and let's take the things step by step. So first of all, on the top, you have all these combo boxes that allow you to jump from one product or one country to another. We don't need to go through this navigation pane, so I'm going to just hide it and focus on the table. So to hide it, I clicked on this blue button here, hide or show the navigation menu. See? Here we go. So what do we have here? First of all, let's read the title. We have the list of the supplying markets for the product imported by Kenya in 2019, which is rice. All right. Subtitle says, Kenya's imports represent 1.1% of the world imports. Okay, so it means that, okay, in the trade of rice, Kenya is not in big demand for rice. Now, that being said, it may be interesting to see how Kenya gets its rice from, right? And the average distance of the supplying country is more than 5,000 kilometers, which means that the rice comes from far. Yeah, so more than 5,000 kilometers is really, yeah, long distance shipping, right? And market concentration is 0.48. So if you remember your first presentation about TradeMap, this tells us, this is an index that tells us how concentrated the supply is. In other words, the lower the number is, the more diversified the supplies are. The higher the number is, the more concentrated the supplies are. And what is low and what is high? Well, actually, it's so in theory, mathematically speaking, this index varies from 0 to 1. But the fact is, if it's if it's below 0.1, then it means it's highly diversified. If it's between 0.1 and 0.20 or 20 or 25, it varies from one interpretation to another, but then it's moderately concentrated, and what is above that threshold, it's highly concentrated, right? So here, in this particular case, 0.48 is actually quite high. Now, let's have a look at the table. We are going to see how high the concentration is, in fact. And here we see that, okay, the total imports of Kenya is about $245 million, right? And most of it is actually coming from Pakistan and Thailand, right? $157 million from Pakistan, $65 million from Thailand. And what we see in the third column, share in Kenya's imports, is that Pakistan represents 64% of Kenya's supplies and Thailand 26%, which means basically two countries are supplying 90% of Kenya in terms of rice, right? So that's basically actually quite a bit concentrated, right? And then we have a little, the remaining 10% is scattered among a certain number of countries, but okay, not that much actually. You have basically 10, 15 countries basically sharing the 10 remaining percent of Kenya's demand, right? So that's basically the very first thing that we can tell about Kenya's supplies of rice. It's highly concentrated. Now, let's have a look first before going further. What can, if it varies from one kind of rice to another. So here on the top, we see that we have the breakdown by country, but let's have a look at the breakdown by product and see what kind of rice Kenya imports. So first, so what we can see here is that Kenya is actually importing semi-milled or wholly milled rice, which means processed rice, right? It's not broken rice, it's not rice in the husk, or it's not husked brown rice, basically, right? So also, so we saw that from a country perspective, Kenya is actually importing just from two different countries, so mainly from two different countries. So it's highly concentrated in terms of geography. And we see that also in terms of type of rice, what the kind of rice that Kenya is importing is basically mainly one specific kind of rice, which is the milled or semi-milled rice. So also in that matter, Kenya is also concentrated. So in other words, to say it differently, Kenya is not diversifying the kind of rice that it's importing. So that's also what we can see from this particular table on the byproduct side. Now let's focus on what Kenya imports the most, and let's see if we have a different picture. So I'll click on the product code, and that leads me back to a very similar table to what we had before, but this time I'm focusing on the semi or wholly milled rice, right? Which is reflected on the top of the screen in the title, right? So in this particular case, we see that Kenya's imports represent 1.3% of world imports, which is a little bit higher than for the whole rice in general, but that doesn't make a big difference. In terms of distance, it's the same thing. In terms of concentration, same thing. All right, so what we observed in the previous table is also valid in that particular table. And just like before, what we find here, it's again, Pakistan and Thailand concentrated about 90% of Kenya's imports, right? Now, that's the situation today. So the question is, how can we identify other countries to diversify the country-wise where the rice is coming from? So you have two options here. Option one, you can say, well, why don't we foster the trade of all these small countries that supply rice to Kenya, because we already have a trade relationship. So we don't need to get into another country that we potentially don't know. So why don't we foster these? So that's one option. Another option is to look into also the bottom of the table and have a look at who is actually also exporting rice and who's actually not and Kenya is actually not importing from. And that's the reason why we have a certain number of countries at the bottom of the table where we have just no value. So for instance, we have Rwanda and USA, all right, for which we have basically no value, meaning Kenya does not import neither from Rwanda or the USA, right? But it's there because there's a small trade balance, meaning actually Kenya has a trade relationship with Rwanda and USA for rice, but the trade balance is positive for those two, meaning Kenya exports rice to Rwanda and to the USA. Okay, and then below we have another two countries, and here I just have, so we have another two countries for which we have no trade balance. So basically there's no trade relationship, neither on the import side or the export side. And why are those two here? Well, it's because actually those countries are actually some of the top exporters of rice in the world, but Kenya does not import from them. Now, you may understand why. Maybe it's because of the logistics, maybe it's because of business contacts, maybe there's a cultural barrier. Well, that trade map does not address those questions. It's your expertise that will come as a complement to the trade statistics. But here, trade map offers you to see who are also the main exporters of rice worldwide, regardless you're trading with them or not. So, so that's the second thing to look at, right? So we looked at the imported value, the share to see how concentrated the things are, and the different countries, and also at the bottom of the table we had a look at the other countries that are exporters but for which Kenya has no trade relationship. To be a little bit more exhaustive, we can display the whole country list. So here, if I'm going to modify the number of rows per page, which is by default set to 25, but I can go to say 300, so that I'm sure I have the whole list. All right. Okay, so here, a bit of a glitch. I've been a bit inactive for quite some time, so I need to redo my command. And here we go. Right. So here I have not only Uruguay and Brazil as also important exporters, but I have also Australia, Spain, etc., etc., etc. Right. So that's the thing. What is important also to see in this regard, so it's not only the static information, but also the dynamic information over here. So here it's just like for the what you've seen already about trade map. You have plenty of information about how the imports have grown over time from Kenya, by Kenya, from the different partner countries. So that's the growth in value. Sorry, this is the growth in value over the last 4 years. Likewise, for the quantities. And that's something interesting to see, is that, okay, worldwide, Kenya is importing more and more rice, right? And the value is growing faster than the quantity. That means that Kenya is importing rice at a more and more expensive price, right? So that's the main idea. But that's not the case for Pakistan, for instance. The first supplier, excuse me. So the first supplier is exporting more and more rice to Kenya, but it grows by 9% a year in value. But over the same period of time, the quantities declined by 1%, which means Kenya paid more money for Pakistani rice, but to get less quantity, right? Which means the prices have increased. Yeah, this is basically what it means. Right. So now that we have looked at the value and the dynamic, we can understand actually what is going on, well, we understand that we have two different kinds of information, which we can actually plot in a single graph. And I'm going to show you this, right? So all what we see in the table over here can be summarized in a graph, which we can access in the graph tab. So, and that's how we can basically conduct a very quick analysis, clicking on the graph tab, and we will see basically here the prospects for the diversification of suppliers. So what do we have here? Here, each bubble represents a partner country of Kenya. On the right side, so on the horizontal axis, we have the share of the partner countries in Kenya's imports. In other words, is the partner country important or not important in Kenya's imports? To say it differently, what is this axis measures the dependency of Kenya vis-a-vis its suppliers. So whenever there's a bubble on the right, there's a strong dependency from Kenya vis-a-vis its partner. So for instance, Pakistan is a bubble completely on the right side of the graph, and that means that there's a strong dependency of Kenya vis-a-vis Pakistan, because Kenya is importing more than 60% of its rice from Pakistan. Right. On the vertical axis, we have the dynamism. So the dynamism of the partners. This is the annual growth of partner countries' exports to the world over the last 4 years. Right. In other words, it means that if a bubble is on the top, it means that this particular country is actually supplying the world with rice more and more in a faster manner, right? This is what it means. So for instance, China and Korea are on the top of the screen, right? Because these are exporters of rice that really completely rocketed up in terms of their exports of rice to the world, not to Pakistan, not to Kenya, but to the world over the last 4 years. Right. And lastly, the size of the bubble represents how big the country is in the world exports in 2019. Right. So as a reference, you have a scale over here. So the brown bubble tells you, okay, a bubble of that size represents 7% of the world exports. Right. So these are basically the three kinds of information that we can quickly see in the graph. So how to analyze this? Well, easily for Pakistan, Pakistan supplies more than 60% of Kenya in rice. So that's why the bubble is on the right. Its exports to the world is not growing that fast, right? So that's why it's in the middle, close to the zero line. And the bubble is more or less of the same size as the scale. So which means Pakistan is one of the suppliers of rice to the world, but that's not the big one. The big one is basically the biggest bubble, which here in this particular case happens to be completely on the left side. And if I mouse over the bubble, then I see that this one is actually India. And India, so if I mouse over and I read the bubble caption, I see that India represents 2.4% of Kenya's imports, which is not very much, not much at all. At the same time, over the past 4 years, India's exports to the world grew by 5%. and the share of India in world exports is more than 33%, right? Which makes it the biggest supplier in the world, right? So basically, a big bubble on the left side is basically a possible country where you could foster your relationship to diversify your imports, right? Now, what's the impact of having a bubble more on the high side of the graph? Well, it just tells you that this country is dynamic and it's growing its imports, which means China is definitely a competitor of India on the world rice market, but the bubble is a bit small, so clearly it's not one of the big players, and Korea is also as dynamic, but the bubble is much smaller. So, so basically, they could supply you, but if you have a big demand, it's not taken for granted that they could actually deliver. So that's the thing, right? So basically, from this graph, we can tell that India is definitely a very good candidate to supply Kenya for rice. So that's basically what we can say from this graph, right? So once again, all this is actually coming from what we have in the table. If I just click on the table tab, here we go. It's coming from this table based on the import value, the growth in imported value over the last 4 years, right? And the share of the partner countries in the world exports. So that column over here, right? Right, and likewise, so what we are missing inside the bubble graph, as I said, I can explain the number of countries over here. What we are missing from the graph is basically all the countries for which you have no trade relationship. So you have no value, so it did not grow or what. So basically, we have no position of the bubble on the graph, so that's why it does not appear. But you see that the share of those partner countries over here, for instance, USA represents 6.2% of the world exports, right? It's the 5th supplier of rice in the world, and actually you're not importing rice from them. Okay, so this could also be a potential country for diversification, right? So that's basically what we can say as a first analysis from this graph. There must be some questions already.
Yep, I think so. So Mr. Bruno is saying that Kenya pay high unit value for Uganda rice, 1,082 USD, while Pakistan, for Pakistani rice, Kenya pay 404 USD. Don't you think that this is why they prefer Pakistani rice to that of Uganda?
Ah, excellent question indeed. So, so the purchase decision, it's definitely about the price, but not only. So clearly, Pakistan has a strong argument to sell its rice because it's cheap. It's cheaper than the average, the average price of rice that Kenya is importing, right? And it's cheaper than Thailand. It's cheaper than Uganda, clearly. So that's a very strong argument. The other, but that's not the only decision that Kenyan importers would take into consideration when it comes to supplying. There's also existing trade relationship. There is the logistics that needs to be taken into consideration, and also the kind of rice. So here we are talking about semi-mild or wholly mild rice, fine, but you do understand that Thai rice is a very thin grain, while Pakistani rice is a rounder grain, right? And this can and these two types of grain can actually address different types of needs or preferences on the Kenyan market. So that's why actually Thailand manages to be in the competition on the Pakistani market, even though the unit value is actually higher. So in the case of Uganda, it's really, really high, right? In the case of UK, it's also extremely high. So maybe here it's a niche market, and maybe it's a very specific kind of rice that is being imported from UK or from Uganda. So that's one thing. Another thing is that the unit value is actually quite sensitive to small volumes of trade. Let me explain this to you. If we take the case of Uganda, Kenya is importing from Uganda $13,000 of rice for basically about 12 tons of rice, right? Which makes the unit value of the rice close to $1,000 a ton. Now, the problem is here with these low volumes, would we have 13 or 14 tons, then the unit value would, for the same price, for the same amount of money, then the unit value would start dropping substantially, just for a variation of 1 or 2% of the quantity. And here, that leads me to one of the limitations of the data. It's the precision of the data. So we publish the data as they are reported by the customs, but there's always a margin of error, right? So that's one thing. Another thing is that the values here are rounded to $1,000, and the quantities are rounded to the closest ton. So in this particular case, there is a chance that the unit value is slightly overestimated or slightly underestimated. I don't know beforehand without studying in detail the data, just because the roundings are here. So from a general point of view, I would strongly advise you to proceed with caution when it comes to super high or super low unit values with very small values and quantities, right? And that's even more the case for UK. Over here, we have $13,000, but only 4 tons, which makes the unit value extremely high. So here, I would say, proceed with caution. Other questions?
Yes, we have another question. How do we know which period is this data for? So if India has 33% of export of world exports, then this is for which period? Is it till March?
So
let me just read till the end, and then maybe you can answer, Christoph.
Okay.
Is it till March 2019 or December 2019? Financial year for some country is April to March, and for some January, December. Over to you.
Good point. Thank you for this very interesting and precise question. From a general point of view, the data are recorded based on the Gregorian calendar, which means from January to December. That's the general way of compiling international trade statistics, and most countries follow this. Just to be completely clear, here we are looking at the status of the trade data for year 2019, right? So that's the status for 2019, and that means from January 2019 to December 2019. So that's the thing. Now, if you have a doubt with the data, whether it's indeed from January to December, or maybe you think it could be from March to from April to March or something, then you have 2 different things that you can check. First thing is the metadata. You probably all have noticed that there is a red eye on the top of the screen in the title. If I click on it, I can access the metadata, and I will see what are the national compilation reporting practices of Kenya. So here the data are reported by Kenya. That's what we can see actually at the bottom of the screen. So if I go till the very end, the source here, it's based on what the Kenya International Bureau of Statistics has reported, right? If you're not an expert of Kenya's methodology, then you can click on the red eye and follow the link to the website of our colleagues of the United Nations Statistics Division located in New York, UN Comtrade, where they have a lot of detail about how the data have been compiled, right? So among other things, the information about the period will be mentioned. Now, because I know Kenya statistics well, I can tell you it's from January to December, yeah, that's the thing. So that's the first thing you can check. Second thing you can check actually is to have a look not only at the trend indicators but at the time series. And of course, you can go to the monthly time series actually. And if I switch to this, then I will see month by month what are the trade values until the most recent month. Now, in the particular case of Kenya, we have the data until March 2020, right? But I can display much more than this, right? And go back in time and see year by year, month by month, what were the trade values, right? So this works for Kenya, this works for India, this works for many countries for which we have monthly data. I don't recall the precise number of the countries that do report recent monthly trade data, but in case you want to know the precise number and whether the country of your interest is covered or not, you just go to data availability, product data availability, and the information will be there.
We have another question here.
Mm-hmm.
For Korea, the cell next to 1861 is blank. What does that mean?
Okay, let me go back to the trend indicators table over here. So here the cell to 1861 is blank. Okay, so in this particular case, what do we have? It says, okay, the growth in imported quantity between 2015 and 2019 is nothing much. Okay, so it means that we could not compute the growth rate. Why could we not? Well, if you want to dig into the computation formula, you have also another eye over here, which is another metadata. So I invite you to click on it and read the explanation over here. It works exactly the same way for the value over here, right? Where you have basically a statistical formula and the detail of the computation if you want to have further information. Now, if you're not a specialist of these statistics formula, the best way to check is to go to the time series. So here, I'm going to try to understand why I have no information about the growth in quantity. To do this, I'll go to trend indicators, yearly time series, right? And I will see here the values. Okay, so the values of rice imported by Kenya from Korea over here. And I see that actually the trade is actually quite recent. It was from 2018 onwards and zero value before. I can just double check this on the quantity side. So here I'm displaying only values. So with the combo box on the top of the screen, I'm going to switch to quantities, right? And I see that for Korea, indeed, there was no value and here no quantity from 2015 to 2017. So mathematically speaking, we just cannot compute a reliable growth rate on the quantity side. Now, if you're unhappy with the fact that on the trade indicators, the quantity was empty, you can still understand that, okay, the quantity has grown in 2019 by 7,000 tons, right? So that's basically what you can get from the yearly time series. More questions?
Yes, is growth rate an average or CAGR?
Ah, right. So going back to the trend indicators, the growth rate is not an average, right? It's basically, it's based on a logarithmic regression. So if you click on the metadata, that's how we computed it. Yeah, but basically the idea is that we take into consideration all the small variations between 2015 and 2019, and we just don't take the first point and the last point and just draw a line. It's a bit more complicated than this.
We have another question. I think it's referring to the price of rice in Uganda, 1,082 USD. Should be a value-added product, or data may be incorrect, or the classification is inappropriate. How to read?
Yeah, so as I said while answering the first question, basically here, so there is a risk that the data is a bit rounded because there are small values and small quantities, so there could be a distortion because of this. But from a general point of view, if the unit value is higher, generally it's because there is value added in there, right? That's the main message that you can take. But once again, here on this particular case, it could be that the rounding could distort a little bit, to a small extent, the data.
We have another question. Is it possible to establish quality of imported product by a country? Example, rice imported by Kenya?
So measuring the quality. So from a quantitative point of view, it's how to measure quality is a tricky thing. Normally, I mean, from a general point of view, once again, if the unit value is high, then the quality is higher. If the value is low, the quality is lower. That's basically the signal. The unit value is the signal for the quality. Now, that being said, if you don't, I mean, there's no other way, according to the trade statistics, to measure it. One more thing that you could potentially look at is the breakdown of the data at the tariff line level, meaning having the detail of the rice with a further breakdown at the most precise level as defined by the customs. Now, in the particular case of Kenya, actually, there is no further breakdown that gives substantial information for the rice. We have here, we can see that we have two different codes, but actually the description is actually the same, which means actually in the past, Kenya used a certain code, and nowadays they use a different code. This actually may be related to the fact that the tariffs have changed over time. But unfortunately, in Kenya in particular, we don't have this kind of information. Now, let me take the opportunity to show you one more thing. Then if we say, let's go on the Indian side, and let's see what India exports, right? So I'm just clicking on India over here, right? And I would, so here I'm seeing where India is exporting its rice to. So Kenya is one of the clients of India, but from far not the most important one. But that being said, we can see the breakdown also by product, right? And here we can see that actually India has on on its own custom side has a different breakdown, a further detailed breakdown, and in particular they identify basmati rice as a kind of rice. Parboiled rice is another kind, right? And then they have all the other kinds, right? And you see that in this particular case, so here I'm switching to the Indian's exports, but basically the idea remains the same. You see that the kind of rice that they are exporting is diversified into 3 different kinds: the basmati rice, the parboiled, and all the rest, right? And then at this level, we can run exactly the same kind of analysis, have a look at the quantities, the values, or the unit values, right? So here you see that I automatically switched to the time series because now I'm at the most detailed level of the of Indian's nomenclature, which goes beyond the international standard, right? So while Kenya on one side said, oh, okay, to define the semi or wholly milled rice, that's good enough for me. I have enough details for my statistics. For India, it matters to split these 3 different kinds, but basmati rice is not an international standard. It's just an Indian standard. So that's why we have it here and we don't have it on the Kenya side. But nonetheless, we can still have the list of the unit values, right? And we can see that actually basmati rice, so let me just display 5 years per page. That's going to look a little bit more user-friendly, exactly. So for basmati rice, we can see that the unit value is actually higher than the parboiled or the other kind of rice, right? You see that's actually almost twice as much expensive. So once again, you can see that here we have an insight on the kind of quality of the rice, not only by the description, but also by the unit value.
We have another question, but just before I share with you the next question, I want participants to know that the main topic is import. Details on the export will be elaborated next session, but it's just a bit of clarification for you to kind of have an idea. But more detailed will be in the next section on the exports. Now, the next question we have is from Ethiopia. Does the value show only the product price, or it includes costs like custom tariffs and other costs as well?
Excellent question. Thank you for this. So the values that we see in TradeMap refer to what has been reported by the customs. And in this regard, there is an international standard. The United Nations came up with recommendations on how to compute, how to compile the values. So basically on the import side, it's the price of the product. It's basically the value of the shipment, including the cost of insurance and freight. So that's with the CIF Incoterm for those who know it. So that's for the import side. Now on the export side, the value are supposed to be valued in FOB, free on board, which basically excludes those costs. So that's yeah. So whenever you try to compare imports and export values, then you will always have, just because of this, you will have a little bit of trade-off, of difference between the values. Once again, if you are unsure of how the data has been computed, just go to the country metadata, and you will have in the explanatory notes and the compilation practices, you will have plenty of information answering this kind of question.
That's no more question at this moment, Christophe.
Very well.
So maybe we can move on to the next.
Let's move on, absolutely. So So what we have seen, so let me just go back. So here we started navigating a little bit around the tool. So at one point, so we started with Kenya imports of rice, and here we are looking at India's exports of basmati rice. So it's something related, but still completely different. So at one point, if you are a bit lost, what you can do is just go to home and search and start your your search again, right? And here I can just replace India by Kenya, make sure I'm on the import side, go back to my trade indicators, and here we go, I'm back from where I'm coming from. So so one last thing to on the diversification of supplies. So we've seen that Kenya is importing only one kind of rice, and it could import other kinds of rice. That's one thing. And we've seen that for semi-milled or wholly milled rice, it was importing mainly from Pakistan and Thailand, and that was about it. And then all the others are very low. And India was actually a good candidate to diversify the supplies. In other words, Kenya could reduce its dependency towards Pakistan and Thailand for importing rice by importing more from India or China and so on and so forth. Right. So that's the idea. From a general point of view, if you want to run your analysis yourself, what you can do is to get query the data from TradeMap and then export everything into an Excel file, and then in Excel perform your own computations. Furthermore, we've seen that we have plenty of indicators, and actually we have more. So if you want to select, what is important is to select carefully your indicators so that when you present your results, you're not overwhelmed with everything. So you can just click on this select your indicators button and pick and choose the different indicators you want. Maybe you're not interested in the growth, so all the trend indicators you could just untick and say, okay, whether my potential suppliers are dynamic or not, I don't care. I just want to know whether they are big or not today, right? The distance, well, for the rice, is not an issue for me. I'm just going to take it out. The ease of doing business, oh, that's something important for me. I want to know, right? Are there some non-tariff measures requirements? That's important for me, right? Instead about market access, I want to know also the tariff faced or the tariff applied. So in this particular case, the tariff applied by Kenya to the different partners to see if me as an importer, it's going to be difficult for me to import the rice from these different suppliers. And maybe by analyzing this, you will understand why Kenya is actually not importing elsewhere than Pakistan or Thailand. So once you have picked and choose your different indicators, you can save, right? And the table updates automatically. And here we have something that could be actually a bit clearer for to analyze what we want, right? So I was mentioning the issues about market access, right? So in particular, this column, the average tariff applied by Kenya, is actually an important one to look into when it comes to diversifying, right? So we said in India, okay, I could diversify with India, and the tariff that me as an importer I would face is 35%, right? So 35% of the value. So if I take the value of the imports and I apply a 35% rate, then that gives me the amount of the custom duty I will have to pay as an importer, right? And I see that actually there's a zero tariff here for Tanzania and here for Uganda, okay? So that's, this is a signal that from the custom duty point of view, from the tariff measure point of view, it would be easier to trade with Uganda and Tanzania, but still it's not the case. I mean, today the imports are quite low. Why is this so? Well, that's basically some food for further analysis to understand where Uganda is exporting to. So then I could do basically an analysis of Uganda's exports of rice and understand why they are not exporting to Kenya. But that would be a different analysis, right? So that's for the tariffs. And then ease of doing business. So here it's basically the world ranking of doing business according to the World Bank, right? Of course, I did not say, but each time you have a hyperlink, if you want to know like the details of this 35% applied by Kenya to say Korea or to India, then that would take you to market access map for you to understand what's behind that number, right? But that's the market access map tool, so that's not part of the topic today. And likewise for the ease of doing business, that would take you to the World Bank and understand what is behind the computation of this ranking, right? So in particular, we can see that, okay, if you want to foster your trade relationship with Korea or with India, that's not going to be too much of a big deal because their ranking is not that bad, right? If we browse a little bit below and say, okay, I want to establish relationship with Brazil, I have no trade yet, so this ease of doing business would be actually a good indicator for me to understand how difficult it's going to be to establish new trade relationship with Brazil. Here, ranking is 124. It's not that great, so you may want to have a look into this to understand if it's something you can work on or not. Right.
Christoph, we have a question
Yes.
about the tariffs.
Mm-hmm.
If tariff for India is 35%, then the figure of 5,897 includes this 35% or excludes?
It excludes. That was an easy one. It excludes.
Okay.
So basically, the custom duty is something that's that the importer is supposed to pay at the border. And as I said, on the import side, the value is compiled CIF, cost insurance freight, which means we include the value of the shipment, the cost of the transportation and the insurance, but nothing else. So it's not, so basically for those who are familiar with Incoterms, it's not DDP, it's not delivered duty paid. Right, so that's basically for the inclusion of the tariff. So that's the thing. Now, so once again, let's have a look at the case of India. And we said, okay, I'm in Kenya, I want to diversify my my imports of rice, okay? So I see that India is exporting to different countries. I understand that India is actually the world's first exporter of rice. Okay, so why don't I try to find someone in India for me who could supply me, right? And that's where the companies module enters in action. So here, once again, I'm looking now at India's exports, and I can click on the companies to identify what are the companies that could potentially supply me in Kenya. So the first thing that TradeMap is asking us is, okay, you asked for rice as defined in the harmonized system, but actually for the companies define their rice in a different way. So the nomenclature the companies use to declare their business is different from the harmonized system used by the customs. So here TradeMap offers you the correspondence table between semi-milled or wholly milled rice into the company's nomenclature, right? So if I want to go for, say, wholly milled rice, I can just say, okay, rice wholly milled. and I will click on this one. And that gives me a list of companies located in India. These are not necessarily Indian companies. This could be foreign affiliates, but it's companies located in India that are into the business of rice. Great. Now, let me manage your expectations here. This is not an exhaustive list of companies, neither for India or for the other countries for which we have companies data. Here, basically, our source is either Compass or Dun & Bradstreet, which are two private companies that are specialized in the data collection of businesses' information, and they provide us with a certain number of information about companies engaged in international trade in the different countries. And this is not, from far, it's not as exhaustive as the business register. Now, that being said, the data which are in here, you can trust it because it's been verified. And the companies agree to share this information publicly. So it's public information here that we are showing. Right. So that's the thing. Now, that being said, we can see the list of the different companies that we have, the number of products they trade, because for a particular company, they might trade wholly milled rice, but also different things, right? So you can see how diversified the company is in its supplies. You have the number of employees, which gives you an idea of how big the company is, where it's located, and that's quite important when it comes to logistics. If you want to ship your rice by boat from India, you might want to choose a city from the West Coast rather than from the East Coast, right? So that's the thing. And last but not least, the website. So basically, it's if you click on it, it takes you to. Oops, sorry. Yes, that's my firewall from from the United Nations. I'm sorry. Let me give another try. Okay, but anyway, so sorry for that. It's not the best. It's not the best example that I've got here, but basically, so if you have no firewall and no connection problem as I do have today, I'm sorry for this. Then you basically see the website of the company and see. Their specific offer. So that's also interesting for you to refine your offer when it comes to finding a supplier. Right. Now, just for you to understand what kind of information we've got, you can click on the name of the company and get more information about what the company does, right? So not only the city and the website, but also the phone number. Also, so that's important to make a business contact, is to actually be able to contact it, and quite importantly, then all the different products that they are producing or trading. Right. So in particular, this company trades rice, but also pickles and also tea. Right. So they are into many different things. Right. But they also do rice. And vis-a-vis each product, you can see whether they are producing, exporting, or doing something else, right? So here the indicator P stands for producer, right? And P/E is that they produce and they export, right? So that's basically what we can say about the company data, and you can see that it can be in terms of product definition. The companies can have something much more detailed than the customs.
Christophe, I think
more questions.
I think you have, the last question is, can you show us how we can access importing company profile? I believe it's something.
Yes, absolutely. So let me just go back from the very start. So I'm clicking to home and search. Right. So I have selected my product. I have selected my country, right? And on the export side, so here I'm looking at India's exports because me as a Kenyan importer, I want to find suppliers, right? So I'm looking at India's exports, right? And what I did is that I went to the trade indicators, right? And I clicked on the companies tab over here. From there, I chose my very specific kind of rice. So I chose wholly milled rice, but semi-milled would just work the same way, right? Right. So now that I get the whole companies list, then I can get the company profile by clicking on the company name over here. Right. So here it's a different company, which basically trades different products than the other one, but that's basically what we've got. Right. So companies tab, select your product, and then click on the company name to get the window over here. So that's basically the way that I followed so far. Now, if you are into companies data only, well, it's extremely simple. Actually, from the home page, you can select your particular product, your particular country. Or if you want to say, okay, I want to do a search worldwide, I'm not going to select any country actually, right? And click directly on companies. Right. So here I'm looking at, right, so I have my correspondence again. So let's go for semi-milled rice. Here we go. Right. And once again, I have the whole thing over here, and this time it's for all the countries, right? And you see that it's reflected in the combo box on the top. As a country, it's all. If you want to filter for India, then you just go select India in there. But selecting all, then basically does a worldwide search. And then you, of course, you can sort the you can sort the table either by the number of employees because you want to select the biggest companies, or by country because you don't want to filter, but you still want to have something sorted geographically, and so on and so forth. So these are the two different ways, either from the trade indicators or from the home and search and the companies button. Other questions?
No, no more questions at this point in time.
Okay, so that's basically, in a nutshell, what we can say about supplies diversification. So since we have a little bit more time, let me as promised, select a different example to have a look into the export side. So let me take the example of sports shoes exported by India. Right. So sports shoes, that's something a little bit precise. So if I just type sports shoes in there, it's not going to return much. Here I have basically two different sorts of shoes. I have sports footwear. So you do understand that actually in the customs nomenclature, they don't say shoes, they say footwear. So that's one thing. And just because by chance I have tennis shoes here in the description, then I get a match. But I'm not quite sure that this is the exhaustive list of my for sports shoes actually. So just to be sure, let me go to the advanced search and search by hierarchy again. I could also type sports shoes in the keywords over there, and that would do something very similar. But in order to have an exhaustive overview of the different kinds of shoes and the different kinds of sports shoes, I will go in the search by hierarchy. Right. So likewise, I'm scrolling. right? So from a general point of view, also, yes, that's not that basic in terms of the harmonized system. The very first products are basically raw materials, right? It's live animals, it's meat, it's cereals, it's coffee, right? And the further you go down the nomenclature, so the higher the code is in terms of digits, the more transformed the product is. You can see that if I move down, then I enter into the chemicals and the fertilizers, and then I go into cotton and different things, and eventually I get my shoes over here in chapter 64, because that's already something transformed, right? So in the shoes, for instance, I have plastic, right? Or I have rubber, right? And that's why it goes after plastic and rubber in the list, right? That's the logic, right? So now that I have identified the shoes, I want among the shoes to identify the sports shoes, right? And here, actually, I see that the shoes are broken down by the material, and that's basically the nature of the harmonized system. What matters is not the use of the product; it's actually what the product is made of, right? So I have the waterproof shoes. I have the shoes with rubber or plastic, and I have the shoes with leather. Okay, and that's the thing. And then if I take the shoes with the upper of rubber or plastic, then and only then I may have something about my sports shoes. Okay, so here I have a little bit of a glitch in my display. So if this happens to you, here I try to expand and then nothing comes out. Okay, so what I'm going to do is that I'm going to refresh the page and start again. Here we go. Right. So yeah. So if this happens, don't panic. It's it can happen either because the connection is not stable or because your web browser is not up to date, and that's actually my case. I'm sorry. You see that I'm using Firefox and I'm not using the latest version, so that's probably why. Anyway, but all that to say that the keeping your browser up to date would certainly ease your trade map experience. Okay, back to my products. I see that, okay, I have my different shoes with plastic or rubber. And here I have ski boots and sports footwear and then other things, right? So this is actually where I do have my, my breakdown that I'm looking for, right? So once again, always keep in mind that selecting your product is about what it is made of, not what's the use of it. Right, now, so let's see what I can get in terms of sports footwear with plastic and rubber, right? And I was saying I want to have a look at the case of India, right? So I'm selecting the product, I'm selecting the country, right? And I can go directly on the export side to the trend indicators, right? And here we go. We see what's the situation of India's exports of these kind of sports shoes, right? So what have we got? So we see that basically, so we have a very similar table as before, right? And you see that, okay, the sports shoes exported by India are going to Somalia and to a large extent, and then Kenya, Nigeria, and so on and so forth. Okay, fine. And then I can basically run the same analysis, but on the export side, just like I did on the import side. Now, you do see that the system remembers my selection of indicators, and here, once again, I'm drawing your attention. Make sure you select the relevant indicators for your analysis. And before, I just skipped a little bit the dynamism for the on the import side, because I said, okay, what I need is a big supplier, and that's why I chose India. And the fact that it's not very dynamic is not a big deal for me. But when it comes to diversifying your exports, then it might be a challenge to look into the dynamism. It might be important. So let me just go back to my selection of indicators and pick and choose what I want. So in terms of basic indicators, I do want to have the basic ones. You see also here, I have something which is not ticked, which is the share in the partner's trade. Okay, I'm going to tick this, and I'm going to explain to you why this is important. I have the quantity and the unit value, the ranking in world trade, why not? The tariff that I'm going to face, that's interesting. The estimation of the untapped potential trade, that's something that I want to know also. So let me take this, right? The trend indicators, yes, I do want to have these, at least over the last 5 years. The growth over the last 2 years, okay, I'm just skipping that one. Right? Market concentration, ease of doing business, okay, I'm just going to untick those last ones just because I want to keep my table lighter, but at one point I may have to look into those indicators as well. But let's start with something not too complicated. I'll save this. And here we go. So my table is updated. And what we've got here is, so once again, the list of the destinations this time where the shoes from India are going to. All right. Now, I see that for the case of Somalia is quite interesting. So that's the first client of India for the sports shoes, right? It represents 36% of India's exports. Okay, so basically a bit more than a third of the exports are going to Somalia. And here I added the share of India in the partners' imports. So here you see, while here I'm measuring how important the partner country is in my exports, me as an Indian exporter. And here I see if India is important in the destination market. In other words, the difference between those two shares tells you how unbalanced the relationship is. In this particular case, Somalia is importing its shoes at 99.9% from India, right? So basically, I mean, to make it short, all what Somalia is importing in terms of sports shoes, it's coming from India. Game over. So here, as an Indian exporter, I have a strong leverage. India has a strong leverage in the negotiation for Somalia when it comes to supplying the Somalian country, right? Now, for Kenya here is the second client of India, right? And it represents 12% of India's exports of shoes, of sports shoes, but it's not even 1%. It's 0.1% of Kenya's imports. So here, if Kenya says, Bob, okay, you're nice, in India, I'm not satisfied with you anymore. I'm going to for another supplier. For India, it's a big deal because then India is going to lose its second destination market. But for Kenya, it's actually not such a big deal because Kenya is going. It's just for Kenya, it does not represent a lot of change for them. So that's basically what it says. Right. So that's one thing also to take into consideration when you are diversifying your export. You may want to enter into a particular market, but if you are already trading with it, you have to see who is if you have some leverage already in the on the market or not. right? So for instance, if I scroll down, you see that basically India is selling also its shoes to Uganda. The value is actually quite modest, but this $487,000 in 2019, it's already almost 90% of Uganda's market. So if you want to expand these $487,000, then actually it's going to be it's not going to be a big change for Uganda because you're already in a dominant position there, right? So that's the thing. So what I did with the value, I can have also have the same analysis with the quantities and the unit values. So likewise, you can compare all those. The dynamism, once again, is important to look at, right? So in values and in quantities. And here, that's too bad. We don't have too much of data in terms of the dynamism of the quantities. Why is this so? That's because, once again, we could not compute reliable growth rates because of the data. So I would strongly invite you to have a look into into the yearly or quarterly or monthly time series to basically understand what the whole story is about. Besides, you have noticed that the quantities are in green. This means that the quantities have been estimated. It's either by UNSD, the United Nations Statistics Division, or us, ITC. Right. So if you want to see, you mouse over the I'm sorry, flu is coming, terrible. So if you mouse over the figure, then you have a bubble telling you where the estimation is coming from. Right. So that's something to take into consideration. And so I have plenty of other things that we could talk about, but one of the main ones is basically the estimation of the untapped potential trade. So that's basically a fancy word to say how much you could potentially sell to those markets. So one thing you could do is actually to sort by the untapped potential trade. And here, now that I have sorted my table, then I see that where I have the greatest potential, untapped potential, is with the USA, right? So with the USA, India can actually is at the moment exporting $4 million of shoes, but India could export 34 additional millions to the USA, according to our calculations. If you want to know what's the detail behind that, you can click on this on the link, and that would lead you to Export Potential Map, which is the tool to identify the potential, the export potentials, and to quantify it. Now in Trade Map, you can already see what's going on, and in particular, you see that where you have the potential, right? It's actually those countries that import the most from the world, right? USA is the first importer of sports shoes. Germany is the second one, and these are the two where you could expand your exports, right? Now that being said, we have identified a potential here for Argentina where you actually don't trade yet, right? So that's basically what we can say in a very short manner, how to quantify the export potential and where are the opportunities. So likewise, all these I can plot it in a graph. And that's where the subtlety is. And I'm going to end my presentation here because it's time is ticking already. So if I go to the graph, basically here I have two different things. I can have two different kinds of graph, and all are with bubbles. So it looks pretty much the same as on the import side, but it's actually telling you a different story. So let me take you through this. once again, we plot each bubble is a partner country of India in its exports of shoes. On the horizontal axis, it's the share of the partner countries in India's exports, so how important the country is as a client, as an Indian client. And on the vertical axis, it's basically the dynamism of the demand, right? So the growth of the imports over the last 4 years. Right. So what we see is that Somalia is clearly the most important client, right? But the bubble is small, which means it's not a big client worldwide, right? And it's not very high in the chart, which means it's not such a dynamic market. It's growing a bit, but not that much. While on the left side, we see that there are plenty of clients, of potential clients for India. The big bubble is the USA, which means it's there's a big demand, it's a big market here, and you can tap into it. Okay. But it's not growing that much. That's why it's still in the middle, right? So in terms of business decision, if you want to have to enter a market where you want to be sure that you have a critical mass of customers, then you would probably go more into the USA. But if you want a dynamic market, because your sports shoes are like quite unique, and you want to, what matters is actually the perspective of growth, then you would go more for upper bubbles such as Tanzania, right? So that's basically the thing. On the top of this, the color of the bubble means something important here. It means whether India is gaining or losing market shares on the countries. So let me take the example of USA, for instance. What we can see is that, okay, USA, the share of USA in India is 2.87%, which that's why it's on the left side of the graph. Fine. So it's not an important client. The dynamism, in terms of dynamism, the import is actually -4%. So the market is contracting, which is not a very good sign. However, the share of USA in the world imports is 15.59%, which means it's basically a large market. So it's a large market in contraction, right? So once again, everything matters here, and so you have, as a business, decide what matters the most for you. And last but not least, we see that the bubble is in blue, which means that India's export to the USA India's export growth to the USA is larger than USA's imports from the world, right? So what does this mean? It means that India is gaining market shares in the USA, right? And that's not the case in Somalia, right? In Somalia, it's a growing market, and India is exporting more and more, but not as much to fill in the demand in the Somalian market. So as a consequence, India is losing market shares in Somalia for that particular product once again. So that's the thing. So basically, a big blue and top bubble. A bubble on the top of the graph would be basically the best choice. And here you have a big bubble. You have big bubbles, but they are a bit low. But most of them are blue, which means that for the potential markets, India is gaining market shares, which is a good sign. So you may want to foster to consolidate this position. So you see, in just one shot, you can have a very quick look of the potential with just one graph. And lastly, let me show you also the different another graph, so you can see that we have plenty of other graphs. So what matters for the diversification in exports is the second one, in which I'm going to compare the dynamism of India's offer and the dynamism of the partners' demand. So that's what I'm doing here. On the horizontal axis, I'm plotting the growth of India's exports to the different partner countries over the last 4 years. And on the vertical axis, I'm plotting the dynamism of the demand, meaning the annual growth of the different partner countries in the world imports over the last 4 years. So, and here we have basically two different areas in the graph. What is so the red line tells you what is the world growth for this particular product, for the sports footwear. So worldwide, the world has grown by 2%, right? The demand has grown by 2%, and there are the demand of, say, for instance, Guinea, Cameroon, Yemen, which are on the, or Tanzania for that matter, which is completely on the top. These have grown quite more than the rest, more than the average, right? So these are the bubbles on the top of the graph. On the top of this, they are on the right side of the graph, which means India is exporting more and more to those countries, right? That being said, the bubbles are small, which means these are not so big markets yet. So here, what we can see is basically the export performance of India worldwide, right? And we see that basically India is doing well in France and Belgium, which are like big markets, and on the right side of the graph, while the big bubbles over here, USA and Germany, these are two big markets asking for shoes, and nonetheless, India is not exporting more and more there. So which is basically a potential destination for the Indians exports, right? On the contrary, UK is a country it's basically a market which is of a substantial size. That's why the bubble is big, but the exports of India to the UK is actually declining, right, by 18% each year, right, which is not looking very good. And you see, because of the color of the bubble, that India on the top of this is basically losing market shares on the Indian market, on the UK market. So basically, the future, as we can see it from that graph, it's more with the European countries, Belgium, France, and potentially African countries, Cameroon, Guinea, Tanzania, rather than UK, clearly. So that's basically what we can say. Again, just like for the tables, you can also click on the bubble, and then that would basically update the graph according to the situation of the bubble that you have clicked on. Or alternatively, you can click on the table, go back to the stats, and say, okay, USA is an interesting market. I want to target it, and then I will click on it, and then here I will go back to a table that we've seen at the beginning of the presentation. That is to say, the country's imports. So here, USA's imports of sports shoes, and as an Indian exporter, you see that if you want to foster your position in the USA, you will have to compete with Vietnam, China, Indonesia, and so on and so forth. And once again here, as an exporter, you will see if USA, when they think at their supply diversification, if they want to disengage from Vietnam or China because they have a strong dependency, or if they want to continue that way, right? And once again, as an Indian exporter, you will see basically who are your competitors. All right, it's already 1:15 Geneva time. I think now is the time to have a last round of questions, and I guess we can conclude. No questions? Or it's either very good or very bad for me.
No, sorry, I just realized that I was on mute. Yes, sure, Christopher. We do have received a few questions.
Okay.
Now the question number one is tons as unit for shoes may not be applicable. Is there a way to look at it as a number of units?
Yes, absolutely. So here from in the particular case of the USA, you have noticed that the quantity is mentioned in pairs of shoes. So that's how the USA has have reported their statistics. Now the thing is, in international trade statistics, there are some standards to report the data, and actually pairs of shoes is not a standard. And that's why when you look at the world imports or the world exports, so let me just switch to the world over here.
Imports, huh?
So here I'm looking at world imports. So you as an Indian exporter, you want to see where the world demand lies, right? And you will see that, okay, in terms of value, we have USA, Germany, Hong Kong, Italy, and so on and so forth. So that's in terms of value, but in terms of quantities, okay, USA said, okay, I'm declaring pairs. Germany said, I'm declaring tons. And not everybody has a harmonized way, harmonized practice of compiling the trade statistics. So that's basically one thing to cope with, and that's why we are not able to have a world quantity, because we don't know how many pairs these 7,000 tons imported by Germany are. Likewise, we don't know these 24 something million pairs of shoes imported by USA, how much it weighted. So that's why there's no world quantity. Now, that being said, you may be lucky and have a look at the yearly time series. And then, so the yearly time series by default will display values. You may want to switch to quantities. And in here, when you switch to quantities, you have another combo box here, and you can display either the primary unit or the supplementary unit. And for those countries that report both tons and pairs, and yes, it does exist, if you click on supplementary unit, then you will get as much pairs as possible. So you see, here I have pairs everywhere. Because I'm on supplementary unit, if I go to primary unit, then the system will try to just stick to the international standards, which means tons. And then for whoever has reported tons and not, then you will have tons over here. Now, once again, those countries that report pairs as a primary unit are countries that do not follow the international standard, which is bad in a way that we cannot have a fair assessment of the world trade, but which may be good for you as a business to understand what is actually going on. If you want to understand the number of pairs and not how much it's going to cost you to ship a ton of shoes, because the shipping fee is generally because of the weight or because of the volume and not because of the number of pairs.
We have another question, Christophe. It's regarding untapped potential. If you could repeat on how to get to the untapped potential.
Absolutely, no problem. So let me go back to the home and search. Right. So I was looking at India exporting sports shoes. So to go for the untapped potential, I was going to the trade indicators. And here, because I chose to have it, I have it on the right side of my table, estimation of untapped potential. It's over there, right? And what I did before is to have a better overview of where my potential is. I sorted by clicking on the column header. But this indicator may not be displayed by default. So in case you don't have it, you can go to select your indicators and make sure that the estimation of the untapped potential trade is ticked. If it's ticked, so make sure you tick it, make sure you save, and that displays the column.
We have another question.
Mm-hmm.
Secondary unit says we know how to convert tons to pairs, or the original data has both the data points.
Yeah, it's the second option. If we have primary and quantity and second supplementary units, meaning in this particular case, tons and pairs of shoes, it means that the customs have reported both units to us. So that's why we provide you with this information. But there is no, to my knowledge, there is no accurate conversion factor to convert tons into pairs or vice versa for shoes. Now we're talking here about shoes, so this is basically a bit on the tricky side when it comes to the conversion, but there are plenty of products for which the conversion is possible. So like if you say like a barrel of petrol or a bag of coffee, these are standardized units which can easily be converted into a weight. So whenever it's possible, we do it. Well, we meaning the United Nations, and this conversion is generally done by our colleagues from New York. But that's not always possible.
The next question is, suppose I do not know the actual nomenclature, how do I find out?
Absolutely. So if you don't know the nomenclature of footwear, and you don't know that the HS code that you're looking for is 640212 or 0219, basically what you need to do is to go to the advanced search. So go to home and search, and click on advanced search from the selection menu. And there you have two possibilities. Either you search by hierarchy, so you click on the search by hierarchy tab, and then you get the nomenclature as it is structured, right? Or you search by keywords, right? And here I can just type sports shoes, and here I have a match of the different products that have the word sports and shoes, or the derivatives, so sport without an S, shoe without an S, and so on and so forth, so that you see what's the proper product code. Now, I would strongly encourage you to perform several searches because the way the customs label the products can sound a little bit weird, especially if you are not just like me, if you are not a native English speaker. For instance, if you type chair, you will not find anything or nothing relevant. I type chair, and then basically I have dentist and barber chairs, and nothing which is related to what I'm sitting on at the moment. And that's because in the harmonized system, chairs are not called chairs; they are called seats. And if you type seats, then here we go. And you have your product. So I understand this can be a bit frustrated at times, but try to if you don't find what you're looking for, try synonyms, because that's generally the best way to go with it. If you still don't find what you're looking for, maybe it's because you have a too precise definition of what you're looking for. So, for instance, if you are a fan of tropical fruits and you want to find dragon fruit, so I just typed dragon fruit, right? Here, basically, I would have no particular match, and then I will have basically the general thing about edible fruits and nuts. Okay, I could have found this myself alone. And then it goes to jams and everything. So generally, it's not, because here I'm very specific, I may want to perform a search at the tariff line level. So I click on tariff line level, and here we go. I do have dragon fruit, and sometimes I even have the distinction whether they are fresh or not, right? Now, why is this so? It's because for those particular countries, Macau, Hong Kong, China, Brunei, and so on and so forth, they have a particular product code for the dragon fruit. And they all start with 081090. 081090, 081090. And that's because at the tariff line level, meaning in the Chinese nomenclature or in the Brunei's nomenclature, they have defined dragon fruit. But at the 6-digit level, so the first 6 digits code is actually something more generic, right? So that's why it can be useful to go at the tariff line level also to understand where dragon fruit or that particular product you are interested in is classified. So to go till the end of this explanation, 081090. Let me search by hierarchy. 081090. So it's actually basically merged together with the tamarinds, the cashew apples, the jackfruit, the lychees, and so on and so forth, right? It's just, so why is this so? So you understand that it's a fruit, so that's why it's in 08. It's not a banana, it's not a date, it's not apricots. It's basically other kinds of fruits. And among the others, it's merged together with miscellaneous fruits because actually the international trade of dragon fruit is so little that it's actually all merged together with all different small traded fruits in there. So that's the thing. So to summarize, go to the go to home and search. Click on the advanced search and then perform your search from that module. So simple question, long explanation. Sorry for that.
Thank you, Christopher. No. So I'm trying to, we have 3 minutes left. So and we have another question. When both primary and supplementary units are available, does it mean that total quantity is primary plus supplementary unit? Or does primary unit mean the equivalent of the secondary unit?
Okay, so let me illustrate this with the table, the trade indicators table that we were looking at. India's exports of shoes. Okay, so basically, so for India, we have data reported in tons. So basically, we sum up all the different tons and we get the total in tons. If I switch to the USA, then everything was reported in pairs and the total is reported in pairs, right? So from a general point of view, the total quantity for a given reporting country, it's always the data as reported in the unit we are looking at. And for those countries that have both pairs and tons being the primary unit and pairs the secondary unit, then in the trend indicators, you will get the total for the primary unit. But if you're not satisfied with this, then you can switch to the yearly time series, right? and then switch from primary unit to secondary unit. Right. So okay, let me switch back to the world. So I'm not selecting USA, but I'm selecting worldwide. Right. So I have some countries that report in pairs, some in tons. Boom, boom, boom. Okay, and that's basically these are the totals. Right. And if I go to supplementary unit, then I get the totals. I get the total by pairs, right? Does this make sense to you?
I think so.
Okay.
I think we should. We have 1 minute left, and the last question, maybe just briefly, how to classify Indian exports originated in India and imported from other countries as trade pack.
I'm sorry, can you repeat the question, please?
How to classify Indian exports originated in India and re-exported from India, imported from other countries as a trade pack.
I understand. Okay, so that's the question about re-export. So, so basically, the international standard for compiling trade statistics says that the re-exports should be included together with the export statistics, and vice versa when it comes to re-imports. So basically, products that have been exported, say by India, and then re-imported at the same in the same state, then that would be included together with the imports, right? So that's the thing. That's actually an interesting question, especially for the trade of shoes, because you see that among the countries that have a lot of demand, you can see that there is Hong Kong, China, right? And here, when you have those kind of territories, and that's particularly the case of Hong Kong, there is a strong chance, if you see them as one of the top importers, that actually they re-export what they have imported to China or to somewhere else, right? So when I say China, it means mainland China. So it means China excluding Macau and Hong Kong. So that's that's basically the thing. Now, let me draw also your attention on this phenomenon. So once again, the re-exports are supposed to be included in the exports, the re-imports in the imports, but sometimes it's difficult for the countries to capture this kind of information. And then what actually happens is that the way a certain country sees the final, the last known destination may not be the final destination eventually. And that's why at some point you may see the Netherlands as an entry point to Europe coming very high in terms of imports, as well as in terms of exports for certain products. That's particularly the case of bananas, for instance. It's because most of the bananas shipped to the European Union enter the European Union in Rotterdam, which is located in the Netherlands. And then from there, it's redispatched throughout the European Union. And it's extremely difficult for an exporter to identify the last known destination. They know the bananas are going to the EU. Their last known destination is the Netherlands, basically because there's a broker there or what. But for the Netherlands, for the European Union, the thing may not be the Netherlands may not be the final destination, right? So this can lead to a certain number of distortions in the international trade statistics. So that's why I would strongly encourage you to take the figures with caution when you have either Hong Kong or Singapore or the Netherlands on the top of your list as a potential destination or as a potential supplier. Maybe there's a third country behind.
Thank you, Christopher. Thank you so much. I think we are 3 minutes past our timing. I know I have few more questions regarding to exports, but I would like to, since next week we are doing market diversification, I believe, and export in more detail, I believe we can address those questions there as well.
Absolutely.
Thank you so much all for your time. Christopher has also prepared a few questions, I mean an exercise package which you will get by the end of the day, together with a recording of the link for previous session and this session when it is ready. Christopher, thank you again. Thank you all for your participation. I hope this has been a very detailed session, and I believe we also had time to go through and practically explain the questions through the demonstration, which I believe it was very useful. Thank you all, and we'll see you on Thursday.
Thank you very much. Thank you for your attention and your motivation. And if you have more questions, don't hesitate to contact our team or just drop us an email on marketanalysis@intrasend.org, and we'd be happy to help you if needed. Goodbye, everybody, and have a good day.
Thank you all.